always look for trades with tight asymmetry near pressure lines, especially if conditions are conducive on neighboring timeframes. So I think we've kind of touched on that a bit. We'll just go to something kind of simple here. So when I say, tight asymmetry backed by logic, you might look at something like near, right? Near, unfortunately, in this case, the channel itself is not bearish, so it's not the perfect scenario. If I was just looking at this one time frame, it's not the perfect situation, because in a perfect world, I would have a red channel and I'd be able to tell you all, hey, look, it's a red channel, and so the long-term trend is down, and then I'd go into all the rest, right? Red volatility cloud, mostly overwhelming blue breakout bars with blue being the dominating pressure and orange just happening intermittently. And I'd be able to say that the movement monitor itself has been mostly blue, right? And so that's kind of how I would look at it. Hold on one second, I'll remove one of these. Okay, so for clarity, I wanted to clean that up. So now, I can say that I haven't seen any green, right? So that's maybe one thing I could say. And even when it was orange up here, the movement monitor never turned so much as green, much less did it turn orange. So these are all kind of, some considerations. But otherwise, I would look at this and I easily, my mind and my eyes just kind of quickly and easily identified the tight asymmetry setup I was looking for, right? So if everything else made sense, and this is why I believe you have time to go through the checklist, right? Because this is a 2-hour time frame. So if everything else made sense, I might go up here and I might decide, to do something like this. I might say, okay, well, when is the next pressure line? I don't know. If it goes down here, even if it's just in a shorter term time frame, this would be really good. This would be a really great place to catch it. And so now I'm just going to use this one time frame as an example. If it happens to have a similar setup on multiple time frames, then that's a beautiful thing. That's like confluence for a setup, which is great. But let's just say somebody was considering entering a trade here. I mean, you could literally kind of move it down and say, hey, you know what? I'm willing to kind of go for that 10. I think 10 is a great asymmetry. I'm willing to go for that 10 units of reward per unit of risk. In case these two swing highs are where it stops, I'll kind of like stop my trade there. In case it breaches my volatility cloud and my pressure line, I will make my trade, stop loss a bit wider. But I like that overall for the 2-hour, it's been pretty consistent. It's held up pretty well. I do have room, right? We talk about linear regression and channel, right? So do I have room in my channel for this trade to make sense? I do. Based on, a very long term, I have room to go down here. And I have these pressure lines kind of backing my play on a take profit zone. So if I know that I have room to go down there, this is perfect. I can do it. If the channel didn't have room, and let's say this was the last big line, right? So in other words, what if this line actually was the last line and that was it, right? And there were like a couple other lines in between. Well, in that scenario, I might say, oh, I just don't have room. The most I think I can milk out of this trade, being that that's the boundary of the channel, the most I think I can milk out of this trade is something like 4 risk-reward ratio. And it to be real, right? Realistic. So do I think I can do that? Does it make sense? Not really. And when I do this in real life, let's just say, I do have to identify the fact that we're in a bit of a bullish trend. So I know what I'm doing. I'm just trying to catch this move to here, even though I think it's going to go up there. And I have to be okay with that, right? And so maybe I catch this move, and if I do really well, I set another one here. Or maybe this is where I front run the market, and I just say, you know what? At some point, it's probably going to come here. I'm just going to long from here. I actually don't care about this one because I like the idea of catching a bigger picture trend. Or I just use hedge mode and I try to catch both, right? And so what does that look like? You can set it all up in advance. I like this. I'm willing to risk 2.21%. I'm gonna use less leverage. I'm gonna use 2x leverage. I'm gonna use a larger capital position. I'm gonna use $10,000, and I'm willing to lose $500. But I think it would be really cool if I did a 2x leverage with $10,000, and over a short period of time, if I'm successful, if I fail, I lose $500, and I'm okay with that. And if I'm successful, it would be really cool to make $6,000, because I would make this 30% to the tune of 2x leverage, right? So my $10,000 would not just be $13,000, it would go to $16,000. My profit would be closer to $16,000. If it works, it's incredible. If it doesn't make it down here and I miss out on it, I don't really lose anything. So the only time I lose is if it breaches everything. It breaches this channel, it breaches these pressure lines, it breaches everything, right? I don't look at it as a loss if I don't enter the trade. It's not a loss. I could set these trades up on any given asset, any given day or month or week or whatever it is. So it's not a loss if I lose, even though sometimes to some people it feels like one. And so again, I may take advantage of this short down to here. Maybe I get lucky and I insert my trailing stop loss, I protect it, and I just catch a little bit of profit, right? Which could take us down to, what is that? 9% profit. I could 4x this trade because I like how tight my stop loss is. I like the logic behind it. I'm comfortable with it. Let's go. So I'm willing to lose my 4 or 5% because I do see the potential for me to make 40%. Same trade, right? I'm willing to lose $400 on the potential to make $4,000, right? If I'm somebody who's trading with $10,000 at a 4x leverage. So you can just look at things and decide on your own numbers. What is comfortable for you? What is uncomfortable for you? What is too much loss for you? And then go from there, right? But I want to kind of just point out what's possible. You could do the same thing with $500, in which case your loss is, you know what, $25, $30. It's like not a bad trade. It's interesting what you can do with a little bit of patience. Both of these require patience. This one could require, a day, a couple days. This one here could require, also many days. And you have to be willing to lose, and you have to be willing to be wrong. You have to be willing to miss out on any given trade. But if you do hedge mode, you will enter at least one of these trades, right? You will absolutely enter at least one. And if you happen to enter the long, then there will be a point in time where you want to remember to close out your short, right? Don't leave that open. If price action just goes down there and then somehow shoots up, like at least rethink it. So that's kind of what I want to talk about there. So we talk about tight asymmetry. I think those are some good examples of tight asymmetry. Or was it? Here it is. Right. So what is tight asymmetry? I personally like, something where you have a lot of units of reward per unit of risk. And when I say tight asymmetry, I don't just mean arbitrarily tight. I mean making it based on some form of logic. Like here's the volatility cloud, here's the pressure line, knowing how volatile near is, knowing how easily it could stop me out. Look how it disrespected that pressure line. I would say, here, look how it disrespected that volatility cloud, right? This could not work. It could go against me. But if it does, I like 12.59 risk reward ratio, and I'm comfortable with losing 0.79 times whatever multiple, right? At a 3x, I'm comfortable losing 0.79 times 3. That's how much money I would lose. Plus, probably some slippage. So I have to be okay with all of that. Everybody's okay with the win. Not everybody's okay with the loss. It's more important that you're okay with the loss. And then, on the winning side, you have to choose take profit zones and logic that it makes sense for you too. You can't be that person that's upset that they got out of near on a margin trade at 3 1/4, even though they made a lot of money, and then be upset that you didn't enter, and you know, near went to $27 and somehow you didn't take part in that, right? You have to kind of just understand that we're human. We do the best we can with the decisions that we make based on knowledge that we have at the time. And so if you want risk mitigation, you know, you have to play the game with risk mitigation in mind in your strategy. So those are some type asymmetries, you know, somewhere between 7 and on up. You know, the higher the better, sure, but you have to make sure it's realistic. So again, pressure lines are useful, volatility lines and clouds are very useful. And even movement monitors can absolutely be used, especially if you could use a movement monitor from a 3-day time frame to make a trade on a 4-hour time frame. Keep that in mind. So you may not want to use the 4-hour movement monitor because price action doesn't respect it a lot. But there's been many cases where I've been able to use the 1-week movement monitor as a support or a resistance, or the 3-day, or even the 1-day, right, as a support or resistance. So just keep in mind you can use that data for smaller time frames, and that's where syncing in layout or syncing globally is useful when it comes to the trades that you're kind of looking at or evaluating. And being able to look at your asymmetry on 8 different charts at the same time, it gives you perspective in each chart, right? Because otherwise it's so tough to find perspective, and that's what trading, I think, is all about. Okay, so let's move on. Line 22. We're moving on. Line 22.